Hello there, it's Walter here, and you're here at the Naked Forex webinar for this week. And I'm just checking my mic to make sure that you can hear me okay. G'day, Manoj and Tina. Vlad is here, Bojan, Edward, Pan, Juan. Thank you, Adinda. Excellent. Well, I don't know how many of you are new to the webinar. G'day, Gabriel. Hi, Canoe. FX Lady is here as well. Hey, Pan. How many of you are spending the first time here? You haven't been here before for our session. You haven't been to one of these webinars. It's okay if you haven't been here. I just want to make sure that it's not, new stuff, because we are kind of going to go over an advanced thing today. A somewhat advanced recipe, as it were. So everybody here has been here before, and this is not your first time here. Great. Excellent. Glad to hear it. We don't have any newbies. Good, then we can jump right into it. All right, so 49er is here. Hey, 49er, what's happening? Technically, I'm also a 49er by graduation. Teo is here, Sebastian, Peter, Maverick, Vlad, Juan, George, welcome, Gabriel, Edward, Forex Lady, Alexander. Cool. Okay, so the last webinar we did, I believe it was the last webinar we did, was all about, it may have been the one before that, 2 webinars ago, but basically, we were looking at a special type of double top or double bottom. Now, today, we're actually going to get a little tricky, and we're going to talk about the same thing, but totally, completely different rules with a very different reward to risk profile. And in fact, it's closer to short-term trading for many of the setups. It depends on how you manage the trade. So it's not technically a scalping system, but from what I'm used to, it is closer to that. So if that makes any sense. It's still sort of swing trading. It's just you can get in really tight. And whereas I usually am waiting for some confirmation, which means the stops get a little bit wider, with this system, it gets really tight. So one of the reasons why it's exciting for some people is because it allows you to get in rather quickly. Now, that means that the win rate is going to suffer a little bit. That's just the facts, right? So, okay. Yeah, some people are having trouble with the chat, but everyone can get through. Okay, cool. All right, excellent. Yeah, as long as you say chat to everybody, I think your questions will come through. Okay, cool. So let's get into it. Is there a chart that someone would like to look at while we're here? A particular chart that you would prefer to see? A chart that perhaps you're in a trade or you're thinking about trading or you took a trade on the chart. Anything like that? Aussie gold and oil, says Pan. We can try the Aussie. Yeah. Yep. The yen, the Swissy, the CAD Swiss, and the Euro yen. Yep. Okay. Well, here's the Aussie. And let me show you, you know what? We might even be better off just going to 1-hour charts. Let's do that. Because I don't want to make this messy. I don't want to mess up my standard charts. So I'll go to these, since I only really go to these on the beginning of the week anyway. Let me show you the basic theory behind this setup. And then we will jump into it. I am going to, it doesn't really matter the time frame, as with most technical systems. However, what does matter is that I get this right in terms of closing prices. And yeah, so this one didn't qualify. 67 and the high over here is 66. Okay. Let's go to the euro yen and we'll see if we get one there. Okay. No. Well, we can go back, I suppose, and see if there are any. Yeah, it's kind of nice when it's a little bit choppy, I guess. Okay, here's one right here. This is, if you look at this setup right here, and I'd like to look at these on live charts, but I just want to give you the basic rules so you can see that first, and then we'll go to the live charts. Because I hate going to historical charts because there's just so much hindsight bias. The good news is with the historical charts, you can follow through all the rules. Okay, so everyone knows what hindsight bias is, right? Canoe, you are always trading the euro yen. If you came here, Canoe, and said you didn't have a trade on the euro yen, I would be shocked. But that's okay. You're what I call a specialist, right? You specialize in one market. Okay, here we go. So let's take a look at this double bottom right here. Now, on the 1 hour chart, there are only 4 candles between touches, which is a little bit, it's nicer to have more. I will say that, but it illustrates what we're talking about here. And obviously, if I had this on a 30-minute chart, then it would be fine, right? So if I backed it up and I went to a 30-minute chart, I would have plenty of room here. And that would have been actually a really nice 30-minute one. So let's zoom in on this one. Okay. So this is how it works. Basically, I'm waiting for the I wait for the market to hit a nice zone. So the reason why this is a nice zone right here is because these candles couldn't get through it and they finally busted through. And then when the market came back down, it bounced rather hard right there with this big bullish engulfing candle, this big bullish, big shadow right here. So does everyone see why I've chosen this level? It's a strong level. It's a nice level. It's a place where I might look for a trade. Now let's say I watched the market come down here and it touched it and it snapped back up and then it went higher. And I said, well, I said to myself, I missed out on a great opportunity here. Maybe I was sleeping or whatever. But I said, if it gets back down there again, I want to take a trade. Now here are the rules for the ghost. There's 2 setups. They're mirror images because one's bullish and one's bearish. This is going to be the bullish setup, and it's called the Ghost Valley. So the Ghost Valley rules are as follows. The market establishes a nice support and resistance zone. Okay? That's number 1. Number 2, and that's already happened here. Resistance, support. So we know it's a nice zone. Resistance, support. Now you can argue with the placement of this line. There's a reason why I put this line right here, a very specific reason. In fact, if I was just drawing a zone here, I'd probably draw it something closer to that, or maybe like that, but I probably wouldn't draw it where I've drawn it here because what I've drawn here is a really specific level to the pip, and I'll explain that in a minute. So the market establishes a zone. The next thing is that the market finds support on this zone. Then the market trades away from the zone, and then it comes back to the zone. So number 3 is the market trades away from the zone. And, again, if you want to put a rule on this, you could say 6 candles or 10 candles, somewhere in there. You normally wouldn't take a trade if it was only 2 or 3 candles. You'd want to see it go away. And then it trades away from the zone for at least 6 to 10 candles, and then it comes back and bounces. So here, the market touched the zone, it traded away for 1, 2, 3, 4, 5, 6, 7, 8, 9, and then the 10th candle it hit again. So 9 candles it spent away. If you want to get ticky-tack and say that these candles are still sitting there, then you would say it's got like 1, 2, 3, 4, 5, 6, 7, 6 or 7 candles. Either way, the market went away and came back down. Now, obviously, what the market did is it came back up, it found some resistance on these lows, and then it fell back down. Okay? Now, this is where the tricky part gets here, because you'll notice that according to to a whammy trade rules that we talked about in the last session, this would not be a whammy trade so far. From what you can see on the chart, it's not a whammy trade. Here's why. Rule number 4. The second touch goes lower than the first touch. Okay? Now, this is the critical defining feature of these trades. The second touch goes lower than the first touch. So it's sort of the opposite that we were talking about before with the whammy trade. So what happens here is the market came down here, and I'm interested in what the low is here. That low is 137.15. And that's why I've drawn this zone here at 137.15. So that's why this zone is drawn right here, right? Okay, good. Now, then when this when the market goes away, it comes back down, and the second touch takes out this low. In other words, it goes lower than the first touch. However, there is another defining feature about this trade, and this is what makes it work. The closing price of the second touch is higher. Close of the second touch is higher than the close of the second. How do I say it? Closing this. I don't see. The problem is when you put too many words in here, you lose the box. It won't put all those words in there if you put too many words. The close of the second touch is higher than the low of the first. Okay. Okay. So sometimes you can't fit all that stuff in there. It sort of cuts your comments short. So that is the important rule here. And I'll show you how we play this. So the market establishes a zone. The market finds support on the zone. The market trades away from the zone. The market comes back down to the zone, touches it again, and it goes lower. Now, this is important. The reason why it has to go lower is it's got to clear out the stops that are down here. So you often see it's kind of like a magnet. The market is sucked back down here, and it has to clear out those stops that are down here below this first touch. And then the market snaps back up, and it closes higher than the touch. So that's what happened here. The market touched here, and the low was 137.15. The market traded higher, came back down, and how low did it go? It went to 137.13. It went 2 pips lower. It doesn't matter if it goes 2 pips or 20 pips. The most important thing is that the close of this candle must be higher than the low of the first touch. Are there any questions about that? This number 5 rule is absolutely critical. And this is where people get into trouble, okay? Now, if you're an indicator trader, you might even slap an indicator on here and look for divergence, okay? I'm not going to get into that because I don't think you need it. I think you just need to pay attention to price action. As you know, I wrote a book on naked Forex, and I like naked trading. So that's kind of my style. But I don't have any problem. I will get a ghost peak canoe in the next example. This is just the reverse of that, called a ghost valley. It's the same trade in reverse. Okay? So it's no big deal. Does that make sense? Hopefully that makes sense. No, sorry, I'm just being a ghost. I just got distracted by my phone, guys. Sorry. I will not pay attention to my phone during webinars. Okay. All right. So let's get going here. So the close of the second touch is higher than the low of the first. Now this is how we trade it. Now this is a very aggressive trade. It's not for those people that trade kind of like, you know how I have like really far stops and I wait weeks and stuff like that. You know, if you've been following my gold trade, that took weeks and weeks and weeks to end. But this is very different to that. And you have to be careful because if you don't follow every single one of these rules, you're going to get into a lot of bad trades. And I'll show you what I mean about that in a second. Okay. Yeah, Drew said the rule number one of all webinars is don't pay attention to people texting you with very important messages during the webinar. And I agree with that, even if that person happens to be your wife. Okay, I totally agree with that, Drew. And the second rule of life, number one rule of life is don't text during webinars or even look at your text messages during webinars. And the second rule of life is happy wife, happy life, right? So those are the two rules. And it's, when they're in conflict, then we get into a bit of a trouble. Okay, so let's see. You guys are funny, and now you're really hitting me hard. Awesome. Okay, so all right, so let's take a look at this. So this is how I trade this one. I know I didn't take this trade, but this is an example of what a trade that I would take. Now, if I had indicators on here, I might throw up an indicator and see if there's divergence here. In other words, even though there's a lower low here, I'd see if there's a higher low on price. Now, what I would do here is I get in on the close of this candle. So the entry is on the close. So that's number 6. There's no confirmation. There's nothing. No waiting around. This is an action, boom, boom, bam trade. You get in on the entry, on the close. The entry is on the close. Now, what about the stop? Well, the stop is, it sort of depends on the time frame you're trading, but I really love to use a 50 pip stop. If I'm trading a more like the pound yen or the pound New Zealand or the pound Aussie, something that just is or the euro kiwi or something that just is wild, I will push that out to 60 or 70 pips, but generally it's 50. And here's why. Because if it goes 50 pips, it's really gone bad, right? And this is a 30-minute chart, right? Now let me explain. So the stop loss is 50 pips. However, most of the trades never hit the stop. Now it doesn't mean that most of the trades are winners. It means there's another exit strategy, or there's another exit signal here. So stop is 50 pips. And then the second way that a trade is closed at a loss is if it closes below this low. So the reason why I've drawn this line here is I need to know if one of these 30-minute candles closes below this line. Because if that happens, the trade is over, right? So the stop is 50 pips, and that's the emergency stop. That's sort of line in the sand, really bad news. Everything, it hit the fan, and now we've lost money. But the exit for a loss is when the market closes lower than the first touch. Okay, so you're usually gonna get a loss, not when the stop is hit, but rather when the market closes lower than the first touch. So in other words, if it closes below this line. Remember, the line was drawn on the low of the first touch. Low of the first touch in this case, 137.15. Okay, so let's see what happens here. Obviously, after the market starts traveling along, it goes lower, in fact, here, right? But, one, it doesn't hit my stop. It only goes as low as 09, okay? And remember, I got in on the close of this candle. So I got in at 20, so it went against me, 12, 13 pips, and then it came back up. And at this stage, I'm not getting out. In fact, in this stage, I'm kind of thinking, wow, this is really looking good, the way that I have this little mini tiny kangaroo tail. I got some tails showing me that the market may, in fact, go high. Oh, what? What happened? I just hit the wrong button. Sorry. This is crazy madness. You kidding me? So now I see the market goes up. Oh, and what about profit target? Okay, obviously this one has a really clear one, which is right here. And there's two ways to trade these in terms of targets. The two most common ways. Number one is to just take a quick, almost like a scalping trade, like take a quick hit and just go for the first obvious level, which for me, the first obvious level is right here. Right around, 137.45 or so. Okay? So it's about 25 pips or so. Remember, even though I have a 50 pip stop, the average losing trade is not 50 pips. The average losing trade on a trade like this is going to be about 20 pips. So, that's one way that I can trade, is just shoot straight away for a 25 pip target right here, which happens to be right here. Now I could also split my exit and put another one up here at this level or whatever. The point is, it's just a real obvious level. Now, the other way to play this, which is much more aggressive, is to simply shoot for the stars. Or you can do a little bit of both. So the obvious first place that the market's going to have trouble is right here. But if I really wanted to go for it, I could actually go for like up here. That would be, remember, on this trade, I'm probably going to average about a 25 pip loser or a 21 pip loser. Somewhere in this area is where I'll probably get a candle that closes and gets me out of it. I could get lucky and get a 10 pip loser, and I could get unlucky and get a 50 pip loser, hit my stop loss down here. But most likely, it's going to be somewhere in this area where I get hit if it is a loss. But if it's a winner, guess what? I've just made, remember, my average loss is about 20 pips, and I just made 77 pips. That's better than 3-1. So you can see you don't need a lot of winners on these to really to milk them and do well. Okay? So let's just see what happens on this one. It keeps going up and boom, hits target 1, comes back down, and it hits my break-even stop. Because I would have moved my stop to break even here if I'm shooting for this one, and I get stopped out right there. Okay, great questions, guys. Let's jump into the questions here. Jaspreet says, after the first touch, there is a bullish candle. Can I put a buy stop at the high of that bullish candle? Yes, you can, Jaspreet, but this is very, like I mentioned kind of at the outset, that's kind of like, that would be the conservative, normal way of trading these kinds of touches that I trade. And this one's much more aggressive, right? Yeah, 4 hour and 1 hour, exactly, Matej. Exactly, you can do it in any, the only reason I put it on the 30 minute was just because I wanted to make sure there were 6 candles between touches. But I love it on the 1 hour and the 4 hour. So let me show you, we'll get into some more examples. But Jaspreet's question, which is basically, depending on which candle you call bullish, you might call this one right here a bullish candle because it's a little kangaroo tail, it's got some space and everything. Or you might call this green one a bullish candle. Most people are going to call one of these bullish. Most people are not going to call this red one a bullish candle. The reason I don't wait for the confirmation here is because here's what will happen a lot, is the market will make this double bottom here, and it'll go up and only a little bit, and then it'll come back down and break. So to guard against that, there's two things I'll do. One is I move to my stop loss to break even rather quickly. Like when it gets to this first level right here, I move my stop loss to break even. Even if I don't take profit, I move it to break even and just hope that it gets up here. Okay, it didn't. It came back down and stopped me out. Who cares? Who cares? I took risk off the table as soon as possible. And, once in a while, I will get a giant winner like that, and it's going to make all the difference in the world. But the reason why I don't wait for that confirmation candle is what happens a lot, and we'll see if we can find some more examples here, but what happens a lot when you do that is your stop is just, it's too far. So, whereas here I can put a 50 pip stop on the close of this candle, and that 50 pip stop is really, really safe down here. Because if the market goes down here, it's obviously not a double bottom, right? But let's say I waited for a bullish candle, and let's say that I didn't get this little tiny green bullish candle, but instead I got a really strong one here. Well, right away, already I've missed out on 20 pips of profit, and then my stop loss is also that much closer. And when my stop loss is right here, this is actually, in a dangerous spot. to have my stop right here. So that's just one of the reasons why I get in on the close is, yes, I know it's not a good win rate, and I know that they're going to be losing trades, but I'm pretty quick to move my stop to break even. And so I'm not, for me, I kind of look at these as, you're almost like catching a knife, And I know you've heard the stories about don't catch a falling knife and all that sort of thing. But that's really what we're doing here. We're looking at what looks to be a really lovely opportunity to get in on sort of a swing point. And it's not always going to work out, but when it does, with a really low risk, I mean, you can really make a huge, huge profit on these if everything shows up well. So now, obviously, we have an opportunity for another one here, as you can see. But now the line in the sand, or the price, is off of this candle, which the low is 137.08. So it's actually got to clear that low and then come back up. And it doesn't do that here. So it didn't give us another ghost valley. Now, I just want to open up the questions and make sure that everything that I've talked about here makes sense. Are there any questions about this? Lots of questions here. I think the euro-yen, Canoe says, I think the euro-yen 15-minute has the pattern right now. Let's take a look. On the 15-minute, you said? Let's see. Yeah. The only issue with this one, Canoe, is that there isn't really 6 candles between. So if you count, so I'm guessing, of course, that you're talking about this. So you have these equal lows right here at 92, 140.92, right? And then the market came up for 1, 2, 3 candles, and then it came back down. So technically, you're right. We would probably, though, have to go to a 5-minute chart. We probably have to go to a 5-minute chart to make it work. And there it is. So there it is. On the 5-minute chart, you can see exactly right. You've got 3 candles here on the first touch. This one's really close as well, but say 3 or 4 candles on the first touch. And then the market moves away for at least 6 candles, and then it comes back and it gives us a really beauty-looking kangaroo tail. And so what would we do on this one? Now, I wouldn't put a 50 pip stop on a 5-minute chart. I have to admit, I haven't traded the 5-minute chart, and it's not a thing that I've done in years. I used to trade the 3-minute, actually. But so what I would say is that, yes, it fits all the criteria. Here's how I'd do it. I would probably use like a 20 pip stop on the 5-minute chart. So that would be entering on the close of this little kangaroo tail here, because it went lower, it cleared out these lows, and then that's getting in at 94. So yeah, I would have my stop loss down here at 74, which is off the chart, basically down there. And the obvious target would be up here at, say, 13. So you're looking at about 20 pips of profit, 20 pips emergency stop, 20 pips of profit, and then the next target would be these lows here, which is, I don't know, that's about 60 pips of profit. So same sort of reward risk ratio if you think about it as the last example we talked about, but good eye Canoe, it's a very, very similar sort of setup. Yeah. Oh, yeah, good point, Sharon. Sharon says, you should really avoid the news. Yeah, absolutely. Absolutely. We wouldn't trade this like right before a news event or something like that. You kind of want to wait for the news event to go. In fact, what would most likely happen is you'd get, especially on the 5-minute chart, right? What would normally happen is you would get this sort of second touch during a news release. And then, boom, you go, you know what I mean? It would be something like that. But on a 1 hour or something like that, it doesn't really matter at all. If we're looking at the euro-yen, let's just go back and scroll through. See if we can get a ghost peak. So we have the same sort of thing, but with the opposite. Here's one actually right here. I think it closed too high. It closed right on it, so it didn't close above it. So actually this one would qualify. So you have this touch right here where the kangaroo tail came up. It's on a nice zone where you've seen a touch there, it looks like a pretty solid. It could be better for sure, but the kangaroo tail touches it, it falls, hovers, comes back up, touches it again, and then of course it falls. It eventually did make it down to your long-term sort of pie in the sky target, which would have been down here most likely, and it would have cashed out right there. That would have been about 140 pips or so on that one. But the first target right here on this one, you're looking at about 40 pips or so, 38 pips, 37 pips. And a 50 pip stop's way off the chart here. But if you did take immediate profit, then you get stopped out at break even on the spike, right? Or on this spike, doesn't matter. Either one of those would have stopped it out. But that's an example of a ghost peak. Let's see if we can find another one here. You'll find that these are actually much more common than moolah trades or whammy trades. Here's an example of a loser. Let me show you. Let me show you an example of a loser. So, actually, this one brings up a good point, too. This is really important to look at. Okay, so this is our first touch right here. And then this one right here is an invalid touch because it didn't go higher. So this first one establishes the high, which the high on this candle is 133.29. Okay, now the market came back up, but it didn't go higher. So this is no good, right? This is not a valid touch. So we're still waiting for that higher high, and we get it right here. That is your higher touch, this spike, okay? So, actually, this might not have been a loser. Let me double check this one. 133.29. This one obviously did go higher than that, but I'm just checking the close on this one. No, it didn't. It actually closed on 29 as well. So it basically, I thought that it closed slightly higher than this touch, but it didn't. It closed right on it. So what that means is you would have held, and you probably would have made really good. This one would have been really good. It definitely would have hit this target right here, which is the easy one. It hit that immediately. Now, if you move to break even, hold on. The close was right here, so this probably wouldn't have been a target. Yeah, I'm not sure that many people would have gone for 20 pips here because it's so close. You would have to sit through this drawdown, a nasty one. It didn't close on the other side of the line. Finally, so the more likely target actually for this one, the more likely target would have been these lows right here or these highs right here. And that was achieved over here. And what that means is that you wouldn't have been stopped out at break even. Because this touch was so close, and 18, 20 pips away, you probably couldn't use it as a target. You'd have to go a little bit deeper. And that means that this one actually had an opportunity to go all the way down here. So again, you're looking at a 1 hour chart. Most losses are going to be in the 25 pip range. They're not going to be the full 50 pips. So you're risking about 20, 25 pips, and you're looking at making about 110. So I don't know about you, but those are pretty good numbers. Even if I only win 40% of the time, I'm going to make money, tons of money trading this. So it's really kind of a cool system. I wanted to show you one where the market actually inched back up here and stopped and basically gave us that exit rule, and I thought this was one, but unfortunately it was a winner. Let's see if we can find one and see what I'm talking about. Here would be one right here. Okay, here's one right here. So here's our high right here. So this is the first touch right here. And then we see the market spike through right here, right? So it spikes up here. It's a very scary, giant bullish candle, but let's say we decided to take it here or even on the kangaroo tail right here. Well, so essentially the entry price is going to be either at 73 or at 71 or somewhere around there. So 50 pips is all the way up here at 23. So what that means is the stop loss was triggered right here when this candle closed above the line at 23 pips. So this is a great example of what I'm talking about here. Even though it's a 50 pips emergency stop, most of the stops exited trades, the losing trades, are going to look a lot like this one, where the market looked like it was going to hold here, but instead it broke higher. And this is a very, very typical result for a losing trade. Extremely common. In fact, they often do this too, where they fall back in your direction, which is maddening. But the good news is the emergency stop is in here. So are there any questions about this? Does this make sense? Hopefully you follow what I'm talking about. Hey, Raul. Is it similar to Last Kiss? No, it's more like a double top, double bottom special case. Nick says, can you look at the New Zealand yen 15 minutes? Yeah, let's do that. Let's see. So you're saying we've got one right now, Nick? Or we might have one right now? Let's see. Yeah. Yeah, this is a great example of one. Okay. So this is a great example of one. Now, this 15-minute candle is going to close in about 8 minutes. So here's our low right here. So our low is established on this green candle right here. Market goes away for 6 candles at least, comes back down, and that's it right there. So here's how this would be traded. On a 15-minute chart, I might not use the full 50 pip stop. I might use like a 30 pip or 35 pip stop, something like that on the 15-minute chart. I could use the 50 pip stop, but, I'd probably be more comfortable with like a 40 or 35 pip stop. So let's just put this on the board here. So let's talk about it. Where's the target? Well, obviously the obvious target's going to be right here. Where's the entry price? Well, the entry price was on the close of this candle, which is at 84.65. So that goes in blue right here. This is a good example for a live setup right now. It does look kind of ugly in terms of it's almost like the one we were looking at before on the euro yen. It is a really ugly looking bearish candle here, but technically it fits all of the criteria. If you were to throw an indicator up here, not saying that it's a good idea, but let's say we're going to use momentum. You might see if you have divergence, and in fact you do. So if you're an indicator trader, 99.56, and right here, 99.58. So you do. This is a higher high on momentum and a lower high. So this low, which is lower on price, is higher on momentum. So that's the kind of thing like you'd be looking for if you wanted to use indicators. I don't think it's necessary, but if you wanted to, you would. Now, that's the price. The entry price is 84.65. So stop loss 40 pips lower would be 84.25, obviously. That's red. Down there, okay? It's actually even further. It's like right around here. And then the target is going to be right here. So we're in at 65 and we're taking profit around 84.83. Now, even though it's going lower right now, we don't get stopped out, right? And we wait for the close. We wait for the close. If the close is an ugly one and below that red line, then the trade's over. Now, I'm going to go ahead and move another area right here. This would be the second target zone, and that's going to be right around 85.03 or so, which is, that's like 40, 50, that's like 40 pips. And then the pie in the sky sort of really far away target would be these lows right here. And this would be like the home run, really excellent, 85.30 level. Does that make sense? So this would definitely be what we'd be looking at here. Now, this candle has not closed. It's got another 4 minutes to go. We'll keep an eye on this and see how it goes. But remember, my stop is down at 25. So it's one of those situations where even if this ends up being, and oftentimes at the end of the candle, it really turns around. So we don't really know what's going to happen here. But this is definitely a valid signal. You can see where all my clear targets are. I'm sure they make sense. The question is the current candle going to turn around, or is it going to give us an exit? You are stop loss hit. No. My stop loss is not hit. My stop loss is at 84.25. Right? The price is at 84.60. It's 5 pips lower than the entry. So it's in a negative drawdown right now. But the stop loss is still 35 pips away. Nick says, good explanation, Walter. Thanks. Okay, great. Yeah. Yeah. Tom says, do you have this setup written nicely in a PDF doc that I can hang on my board with on it? No, Tom, but excuse me. What I'll do is if you go to the Facebook page, I'll post it on there this week, okay? Just look up Naked Forex on Facebook and you can download it there. Cool. Raul, I'm sorry you missed it. It will be recorded, and I will post the rules on Facebook. It's a special type of, it's not the same. See how it's turning around now? Isn't that magical? We still have a couple minutes, but it's the best way to say it is they're double tops and double bottoms, with very, very specific rules. Sorry, Raul, but you will get. If you want, and you want to go to Facebook and get the rules, I'll post them. Yeah. Mustafa says thanks. Okay, cool. Yeah, excellent. Okay, any other charts you want to look at, guys? We will come back to this one. We've got another 2 minutes before it closes. Yen. Okay, let's do the yen. I will remember to go back to that chart, because I want to see how it ends. Now, this looks like it's ready to fall, to be honest. You've got a couple of long tails here, and it's just blown through them. Usually when the market blows for these tails like this, it usually is getting ready to go. I don't really know where it's headed, but I would say, well, it certainly looks like it's headed back down to the low. It looks like it's headed to 101.80. This, I would not, if you're looking at this as a bearish big shadow, I wouldn't count it, because it's such a small candle. The close is quite strong. It should be lower. This candle is very tiny. That's why it engulfed it, and this candle is massive. So, are you looking at this in terms of a ghost peak? I'll go back to the New Zealand yen in a second. Okay. We'll go back to New Zealand yen in a minute when the candle closes. Were you looking at this one as a ghost peak? Because if you were, you don't have 6 candles between touches. Let's just see. This one's going to be close. I don't think it qualifies, though. High here is 103.37, and the high here is 103.3. Oh, it does. It's 1 pip higher. So this would actually qualify as a ghost peak here. I've never done them on the daily, though, so I don't know. I usually do like 1 hour or 4 hour. Let's take a look. New Zealand yen is closed, has it? Yeah, okay, so this would be done. All right, so here's an example of a losing trade. And again, remember what my maximum risk was. It was 40 pips, and I got out for 4, okay? So I got out at 10% of my loss, of my risk. So if I was risking, 1% of my account, I lost 1/10 of 1%, or maybe slightly more. But the point is, you give me a trading system where you tell me a trading system where you can risk that little and make that much. So in essence, what happened here is I was risking 4 pips to make 18. Okay? So right away, that's almost 5 to 1. That's what's so cool about this. Is don't get upset when this happens. Who cares if the market does what this did right here? I'm so glad that I got to get out of this trade with 4 pip loss. It could have been a 40 pip loss, right? It could have been a lot worse. Who cares? I don't care. And in fact, now what I have is I have a lower level here. So if the market decides to come up here and then come back down and bounce, this is where I would look for another. So you see the whole cycle all over again. exact same targets, but now we have a possible, I mean, this is going to be a way, we won't be at this webinar if we get another signal, because it's going to be at least 6 candles up here, and then it comes back down, and then all that. But you get the idea, and the reason why I really love this is mainly because of the exit system. The exit on the losers is so tight and so strong, and the entry is really tight too, because if this is a breakout market, normally it will close below that low. It won't snap back up. Now in this case it didn't, but again, remember, it was a 4-pip, 5-pip loser, so it's no big deal. Matej says, how much does it have to go back up that you take the trade on the bottom again? Well, it just has to go lower than the line, but close above it. So the current line right here, the market first of all, the market has to bounce here, go higher, and then come back down. And when it comes back down, it's got to have a lower low, but a higher close. So if you think about what you're saying here, you're saying the market's gone lower than the last touch, but it's closed back up above the last touch. So even though it's gone lower, it snapped back up. So what's happening? The market's going down there, clearing out the stops, and then it's moving back up, right? That's what the Ghost Valley is all about. So as long as it goes 1 pip lower than the previous low, and as long as the close is not below the previous low, then it's good to go. Does that make sense, Matej? I hope that fits your question. I hope that answers it. Jake, you can email me if you want. Joe says thank you. Brilliant. Okay, let's go with the pound yen. Who wanted the pound yen? It looks like Richard does. Richard wants to take a look at the pound yen and see what's going on. What time frame, Richard? Do you have a certain time frame you want? 4-hour daily, okay. Okay, yeah, okay, right. It kind of looks like to me that these yen pairs want to just come back down to here, I would look for the pound yen to test 166.30. As far as 4-hour goes, yeah. And if you throw up an indicator on here, you're probably going to see some divergence between this peak and this peak, but it certainly looks like it wants to come back down to this level and just see if it's going to bounce there or break through. Yeah. CAD Swiss, would you take a trade from the 84.13? Let's take a look. Yeah, you can use, if you're interested in indicators and you want to look at divergence. You could definitely do that. CAD Swiss. Whoa. $84.13. I don't have one there. I have 85. Okay, let's take a look. Gabriel. 413. So you're saying the level. You're saying there's a level here. Around here. Yeah, that's a good one. You know why I like this one? Because it's got touches from above, so support and below resistance. Yeah, that's a good one. I have it around 84.20, but yeah, I see. And so does that mean that we're on it right now? No, we're beyond it. Okay. I wasn't sure if that kangaroo tail yesterday was on it. No. It looks like it's going to make a move back up there. The best spot to sell it, though, to me, Gabriel, is right here. Whoops. I didn't mean to do that. I meant to go like this. This is where, this is kind of the money shot right there. If you can wait for it to get up to 85.20, that would be the money shot right there. Does that make sense? Okay. Cool. Beautiful kangaroo tail on the 4-hour yen. Wow. Or sorry, 4-hour euro. Did I say yen? Yeah, the problem with this one is it's not technically a kangaroo tail. See how the close here, well, at least on my chart, the close, it is a beautiful looking candle, but the close is outside of the previous candle's range, so it doesn't qualify. The other thing I don't like about it is it's flagging down. So while the candle itself is beautiful, I don't know if it's on a zone one. I don't have one here, but that doesn't mean there isn't one. Yeah, I can see where people would look at this one. The best zone though would be a little bit higher up here at 38.20. But because there's two things that are scary about this one. One, the market didn't close inside the previous candle, and two, it's been staying up here. Not a good sign, right? Not a good sign when the market hangs out at a level like that, because it usually means it's going to go higher. So that's a bit scary. Definitely a bit scary. Here's another one too. This one is technically not a kangaroo tail because the close is not inside the previous candle. But this candle is so small, that's why the close is inside the previous candle. Whereas this candle over here is actually pretty much a standard size candle. So it did have an opportunity to have the close of the kangaroo tail inside that candle, but it doesn't. It wasn't. So Sharon says Matej, the pound is not, it's not really. I talked about this yesterday, guys, for those of you that follow my trades. It didn't trigger, so I was waiting for a buy around 70, 64.70. Now it looks like it's going to come back down here, but we'll see. The pound Swiss did trigger, Matej. It looks like, this is what it looks like to me. Like, I've been waiting for the market to hit 62.60, and it didn't. I thought that this was going to be when it did it. It just sort of hovered there and then bounced. Now I thought that this was the big bullish candle was going to tell the story. And it still may tell the story of a bounce here, but the problem is it didn't take out yesterday's high. So the high during the Asian session was not taken out. So, yeah, exactly. Today, Sharon, today is the day. If the market closes lower on the pound, it's going to probably come back down here. If today closes higher, it's probably going to take out this high. But either way, yesterday was the day that I had a trade on to see if we would, in fact, clear out yesterday's Asian high, which was right here at 64.64. And it didn't do that. So now I'm just waiting. I did have a weekly setup on the pound Swiss, and that did trigger yesterday. So that one is actually in play. And I'll show you that, and that might be the last one we have, we're going to have to go. That may be our swan song here. Let's see. This one. Yeah, see, look at this. So these are my numbers for my pound Swiss. This is a bearish big shadow weekly chart trade. Stop loss at 48.39, which is outside this big blue box. Triggered at 45.57, so it's just in a few pips profit now. Targeting 44.10, which are these lows, and then 41.10 down here, which is the edge of the box. The thing that you'll notice about this one is the market went down, and then it came from here to here, came back up, traced 61.8%, almost to the pip, and now it's printed a bearish big shadow. So everything about this says sell. I waited for the early part of the week for the market to go up, and now the market's going down. There isn't anything about this trade that looks ugly. Everything about it looks textbook. Everything about this trade looks like it's going to go well. And so for those of you that followed my trade yesterday, you know that this is the one that, this one and the pound were the two that I was waiting on, and the pound didn't trigger, and this one did. So, but then again, this one was a weekly trade and it has all week to trigger, whereas the pound only had yesterday to trigger. So, no, Pan, I don't do that. I just treat them separately, really. I know how to run correlations because I, got a degree and stuff and stats and blah, blah, blah. But I just tend to, what I've learned, and I just tend to treat them separately. Yeah. Okay. Thanks a lot, Raul. Thanks, Pan. Thanks, Day Trader. Great guys. Great to see you here. I really appreciate your time. I hope you have a wonderful trading week. Thanks so much. I'm glad you like it, Pan. Thanks, Jake. Thanks, Gabriel. Take care, Canoe. Bye, Richard. See you, Maverick. Have a good one, guys, and we'll see you next week. Bye, Adina.